right. Good morning. Today is Thursday, June 26, 2025. Welcome to this month's Capital Markets Update and Outlook call. We are live on our website as well as all of our various social media pages. So if you are with us here live today, thank you for taking some time out of your busy schedule. If you are watching in the recording, a special thank you to you as well. We appreciate you taking the time to be with us. If you are new with us here today, my name is Eric Hagan. I am a financial advisor. I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, of Chief Investment Officer Tom Fox, who you will hear from in just a minute, financial advisors Dan Oshman and Rana Grant, and our client support team, John Knutson and Karen Miller. Together, our goal is to help individual investors make their next financial decision, and the one after that, a good one. One of the ways that we deliver on that commitment is through today's monthly update. Today is an opportunity for each of you to look over our shoulder, get a balanced analysis of what we see, and ultimately to be a more informed investor. Today, we're going to hear from Tom Fox. Tom is going to review the positives in the markets and the economy, the headwinds, and give us his outlook moving forward as we progress here through 2025. Ultimately, again, this is your opportunity to kind of look over our shoulder, get an idea of what we're seeing in both the markets and the economy and what we're watching out for. So with that, I encourage you, if you have any questions whatsoever, put them in the chat box. If there's a chat box on the media site that you're watching from, or I have my email here if you're watching live and would like to send an email. We'd love to field those questions. We will have Q&A at the end. Tom spends all of his time more behind the scenes doing market research, due diligence, running different analyses, and really focusing his attention on the economy and the markets. Tom has over 35 years experience building investment strategies. He has an impressive long resume, and as always, I'm very excited to have him here with us today. Again, at the end of today's message, can't not stress this enough, we will have Q&A. We'd love to take your questions. So if you're watching online, whether live today or in the recording, please feel free to ask any questions, and I'll present them to Tom at the end of today's message. If you're watching in the recording, we will get those messages, and we would love the opportunity to circle back with you. So with that, I'm going to bring our theme up for the year and bring Tom to the stage. Good morning, Tom. Welcome.
Good morning.
We can hear you loud and clear. That's awesome. Love it when
That's
technology
great.
works, right? So happy Thursday. We appreciate you being here. We got our a theme up here on the screen for you as we continue here in 2020.
Yes. And you can see the times are changing very rapidly this year. So
That's
that
true.
I know we had that theme last year, but we carried it forward and now it's coming to pass. There's so much change going on, whether it's the Middle East, policy, everything's changing, and the stock market is close to all-time highs. And so we'll talk more about that as we go forward, but we always like to look in our outlook. We want to start off, well, what's the wall of worry? Because markets tend to climb wall of worries. There's always worry and uncertainties. So I've listed 10 of them there. The first one that we're going to look at is why the stock market, may not go higher or may go down, is that valuations are elevated. Forward PE ratios and long-term averages are above long-term averages, especially in the large cap tech area. So everything seems to be kind of priced to perfection unless we have earnings growth that continues and the companies continue to drive out those revenues and earnings, which they have surprised to the upside. And we'll look at more of that on the other chart or other list, which has the reasons we should be in the stock market. And the other risk out there is the narrow leadership, just a handful of mega caps driving returns. Well, and so the broader market's vulnerable, but what would happen to those leadership that have a big part in the overall market capitalization? For example, the S&P 500 if something goes wrong with the economy or globally, something goes down, those will be the first to go down. And we saw that in April this year, when a lot of these stocks came down in March and April, and we ended up actually entering those stocks at discounts, which is proven now to be very, very good decision. So we have the geopolitical risk. It's sort of settling down now, but we have ongoing tensions with Iran. We don't know where that's going to end up. You got instability across the Middle East, and of course we have China. China's always going to be trying to overtake us, and they are out there as one of our wild cards. But so we have to keep an eye on all of this. Now, one thing about geopolitical risk, it's impossible to predict when that will happen. However, we need to list them because there's something we have to make decisions if something happens. For example, you didn't see us sell any stock during the Iran conflict. We're going to look at some charts on that. We held it because we thought it would be a temporary bump in the stock market, and it was. Okay, so then we have slowing economic growth. This is a big one. Recent data suggesting the U.S. Consumer and economy are starting to cool off. GDP growth forecasts have come down for the second half. So this is an important one, and especially employment. If right now employment's holding, but we're starting to see cracks, and that is a big one we're going to keep our eyes on. On the other side, if the employment begins to crack more, the Fed may come in and start lowering rates. So you may have some offsetting pieces there to keep the market where it is. So then we have sticky services inflation. We have two sides of inflation. Services is one that is still sticky. The core service, we hope it goes down to the 2% target the Fed's looking at, but some parts of it are sticky. But we're seeing some good signs in the inflation. We're going to go through a lot of charts on inflation. It is seemingly come down, but that's a risk. And then we have corporate margin pressure with all the potential impact of tariffs coming over the next month or two. Is it going to injure some of the corporate earnings and profitability? So we're going to be watching that and their margin pressure because of the tariffs, and we'll see where that all ends up. That's a big part of many things we're watching for, and we're going to see what happens with that I think the next 1 or 2 months will determine the outcome of all these tariffs. Then we have record short interest and hedge fund under pressure, underexposed. So what this means is that the smart money has been shorting the stock market. Now, this can work in two different ways. One is that they know what they're doing and the market's going to begin to tank very soon. Or two, they're on the wrong side of the trade. And if they're on the wrong side of the trade, it could be short squeezes, which we're seeing right now. We're right at the door of short squeezes. If this market breaks the old high, a lot of money may flow back into the stock market to cover their shorts because they're losing money and they're outside the market. Even they're underinvested in the US, which is really starting to take off. So we're going to keep an eye on this one. And so there's a lot of smart money that are underexposed to stocks, and we'll see what happens there. Then we have the continuation of policy uncertainty. There's tariffs we've talked about, taxes. Is that going to the beautiful bill? Is that going to go through? Regulations. And so market-friendly policy is not guaranteed. Right now, we think under President Trump that if it all works out, that it will be positive, but it is a risk out there that we're watching. And then many of the overbought technical conditions. So we're seeing a lot of movement and to the upside in stocks, and we may be reaching a point where it may consolidate as the market keeps grinding higher. So you may have some overbought areas, and that's what our technical analysis says, but that's typically very short-lived. But you may have short volatility to the downside, but we would expect that, and it would be healthy, actually. So then we have high concentration risk. Technology accounts for a large part, 40% of the S&P 500. So if there's any cracks in technology, we're not expecting that, because the AI growth that we're seeing and the AI interest and this AI investments, everything is going AI, and it doesn't seem to be slowing down. So we don't see that cratering, but has high P ratios. And the reason it has a high price to earnings ratio is because it is growing tremendously. But right now, we don't see any signs of that slowing down. In fact, it could be picking up. So those are our wall of worries. And we're continually looking at these. We always want to have the balanced view of positives and negatives. So this is what we're watching right now. Okay, here's 10 reasons to own stocks today. The first one is strong corporate earnings. Despite all the risks and all the fears of tariffs, companies are still bringing home the bacon. Their revenues and earnings were great. Especially in the technology area, which shows that this momentum towards AI is continuing. So this is one reason to be in stocks. Corporations are doing well. And of course, we have the AI and productivity boom. AI will eventually start to impact productivity in other companies as they learn how to harness the artificial intelligence. So we'll see that, and it could be boosting productivity, which of course is positive for earnings. And we'll see how that's a big positive. Why to be in the market? And we have a good weighting towards the AI component. We have to be diversified, but we've structured the portfolios to have plenty of AI in it. So we got record amounts of sideline cash. This is gunpowder on the sidelines, 7.2 trillion in money market funds. I've got a chart on that. We'll be looking at that. This is where a lot of the money went into. It's been growing. It's up over 7 trillion. So what if that money decides to go into the stock market? And as we start reaching new highs, that could trigger fear of losing out. So many investors may say, I'm going to lose out. I got to get in. And they may move their cash over into the stock market. We're already fully invested. We've already had your portfolios fully invested. So we're very comfortable where we are, but there could be what we call a face ripper. And that's where people saying, I got to get into the stock market. It's going to new highs. And if that happens, you're going to see huge upside to the market. And then we have buybacks, it's a supply demand. If you take more supply off the table and you still have strong demand, economics 101, you'll see that there's less stock available because companies are buying the stock themselves. So what happens, that tends to be a winner for companies that are buying back stocks. And there's actually been a lot of studies and research on companies that buy back outperform those who do not buy back. So there's some other factors that are in that research. But if that happens, we could see more earnings per share, more boosting in the technology area and support to the market overall. So that's a very positive. Then we have rate cuts are coming. The Fed is still holding that they're going to do 2 more, which would be a bullish thing. Of course, their eyes are all over employment and the economy. Inflation right now, all the hard data is pointing that there's not an inflation problem. In fact, it's been coming down. But I think over the next 1 or 2 months, we'll be able to see what the impact of the tariffs are. And is that going to be short-lived? Is the market going to discount that and look down 6 to 12 months? We'll have to see. But that, I think over the next 2 months, there's a lot of data that's going to have to come in. But right now, all the hard data points to inflation is controlled right now. When we'll look at a bunch of charts on that. So that probably will lead to 2 more cuts. Global capital markets towards U.S. Right now, the U.S. is the hot spot for countries to invest in. So we're seeing billions of dollars coming into the United States. And this is, of course, what President Trump has always wanted, that more money would be invested in the U.S., more factories, more businesses. So that is happening. And right now, we think this is going to be even growing faster as we move forward. So this is very positive for our companies, for our economy and so on, upholding the economy. So if you heard the recent meetings that Trump had overseas with NATO, they're all talking about the U.S. as being the hotspot for investments. That's all bullish for our stock market. And here's what's happening. All the analysts that are out there, like me, have raised their S&P 500 target. We've seen a lot more analysts raise their S&P target for 25. And that could continue because they see continuous growth. And so do we. We're in that camp. And we'll, at the very end, you'll see we've raised our target as well. So what we have is we have a weaker dollar. That could benefit the stock market. When you have a weaker dollar, then our companies can sell more product because the international companies that are buying our products, they can buy it at a lower price because their dollar is stronger to the U.S. So that could be a tailwind to a lot of companies that have, doing a lot of business overseas. And then we have technical breakout. That's happening right now. We're seeing the S&P monthly broke through its resistance levels. And if we hit this new high, I think you're going to see a lot more upside. And it's the fear, again, of missing out. So, but the technicals are maybe overbought right now on the short term, but they are looking really good. And then, of course, long term, you have the demographic tailwinds and the retirement flows overall, the baby boomers and the Gen X. They're all getting into the market. They have huge retirement accounts. So there's a lot of money that is expected to be a tailwind for stocks into the future. You could probably put this one with the AI future, with the demographic future as well. All right, I put this, there's Trump. I think I've had his face on there for a few months. Trump tariff agreements. This is a big thing we're looking at. And of course, Middle East peace. Will it hold? Nobody knows the answer to that, but we will watch over the next several months, specifically, especially for the tariff agreements, what happens, what Trump decides to do, and how that impacts our imports and how it impacts our own inflation. But right now, the market hasn't been hurt by the Middle East wars, and the market has not been hurt by the tariffs. So this is something we're watching. And of course, it's unfold and it changes every day. So we're kind of excited about watching what happens over the next 2 months. All right, reasons to be bullish, and we are bullish. These are the stock returns through June 19th, and it shows the average return since 1975 for that same period. And you can see that the U.S. stocks have underperformed relative to past periods, almost the first half, just through 19. Thank you. But you can see the bars, the recent bars, you can see that international stocks have done very well and have beaten their long-term average. And bonds are about equal, and commodities have outperformed. But right now, there's a rally going on in U.S. stocks at this time. So we may see that number go much higher than what we're looking at today. But what it shows is there's been, with all that's going on in the world, there's been tremendous resilience, and stocks around the world, in the U.S. now, are starting to really move, and we expect that to continue. Here's one of the reasons. You can see that earnings estimates surpassed prior highs, and this was not expected to happen or to be lower. but now we're at new levels on earnings estimates, and we're expecting that to continue. And this is one of the big reasons our stock market has been rallying recently, is that we're having such great earnings. Here's that. We talked about buybacks, but you can see that they have been increasing since June, early June. This is every week, but you can, or no, this is annually showing each year, but already this year we've outperformed, companies bought back because our balance sheets are so good. They're buying back their own stock. And again, this is a record compared to the last since 17, but you can see it's really growing, and it's rising as we speak. So companies are feeling good about their stocks, because you normally don't buy your stocks if you think the future is not going to be good. So internally, that's telling us that CEOs and CFOs like their pricing where they are now, because they think it's going to go up. This is a very positive sign. And so this has been increasing, especially this year compared to the others through this period. Here's the large pool of cash on the sidelines. This $7 trillion, plenty of gunpowder. And you can see the breakdown of institutional to retail. But what's interesting, the smart money, the institutional, has been raising cash. And here we are approaching new highs in the stock market. Will they reverse course? Will the retail reverse course? And so if that happens, this money could fund a major rally or continuation of our rally as we go forward. So this is going to be interesting if the market keeps going up. Sort of the trigger that could, again, send this off and this money to pour into stocks would be if we break the new highs. And we're very close to doing that. When people say, hey, I can't be on the sidelines anymore, I got to get in. We'll see what happens. But thankfully, we've been in and riding this beautifully. Here's hedge funds. They've been increasing their short positions. Lowest position 12 months. Actually, they've even raised more short positions as this market rallied. Again, I look at it as a contrarian indicator that they could be on the wrong side of the trade. Eventually, if this market squeezes, this is short positions, which means you make money if the stock market is going down. You lose money if the stock market's going up. Well, the stock market's going up. Are they going to close their short positions because they're losing money every time as the stock grinds higher? And there could be an avalanche, or some call a face ripper, where they come into the market and we see all this cash start to move. All the short position covering begins to go the other way. And we'll have to see. But it's amazing. A lot of hedge funds are going to have returns this year. This is the smart money, smartest people in the world in investing. And they're right now on the wrong side, many on the wrong side of this trade. All right, geopolitical shocks lead to have short-lived impact. They don't tend to go very far, and these are several that have happened historically. You can see oil spiked on average 9.8% in that first column, a third column called oil spike. And when the oil spikes like it did, the S&P went down a little bit. 1 week later, you can see that prices in oil went down. But look at 1 week later in stocks, but look at 1 year later. That's what we want to look at. When you have these shocks, you can see the stock market tends to rebound, and so does oil. So oil shocks tend to not last long. And we've been through plenty of them. And it's sort of the same thing. This oil prices go down, and go down or go up, and then of course stocks get hurt a little bit, and then what happens is it rallies back over the next 12 months. So short-lived, we don't get too worried about that, and we'll see in other charts what happened this time with the invasion. And we'll look at more other types of risks that are out there, geopolitical risks. Oil prices tend to fall shortly after those risks. So this This is just another graph showing you what happens to prices. You can see they go up shortly, very short. They go up and then they fall right after the shock. So this is just another chart reinforcing that. You can see a little up in pricing right when the shock occurs. And then, of course, shortly after, it begins to fall and go to even lower places in oil prices. Well, what happened on this one? To the next slide. All right, what happened this time? Many forecasted that if the U.S. got involved, prices of oil could go to 150. Well, what happened? They dropped. They went the opposite way, down to 67. It was a short bump to 78. But as you can see, it was very short-lived, and it went down to 67. So the impact of the U.S. getting involved, Israel and Iran war, actually had the opposite impact as what most expected, and which is very interesting, meaning that, and there's a number of reasons why. We'll look at the next chart, what this potentially means. For the U.S., this is our net oil imports. How much oil is the U.S. bringing from overseas? And now you can see we were bringing in lots of oil, especially in the 70s and in 2008. We were bringing in lots of oil. It was almost 3%, or was 3% of our GDP quarterly. And what happened now? We're exporters. You can see we're not importing. We're the net import export. We're now exporters, net exporters of petroleum. This is why the U.S. stock market didn't get rattled. This is why oil prices didn't go up, but except for a short period, and they came down, is because this is a big part of our security here in the United States. We're now exporters of petroleum, not importers. Fracking is the main reason for this. With the advancement in technology we can extract more petroleum, more oil out of the ground than we used to. And it's we have natural gas, we have oil. We are the biggest producer now of oil and gas. All right, this is post-invasion. What happens? Historically, in this 5 out of 7 times when there's been an invasion, the market rallied shortly after. And this is important. You can see the lower right, on the lower right chart, you can see I circled it. That's on what happened this time on the Iran invasion. When we came in and bombed the nuclear sites, you can see that it went down and then it rallied back. And it's even much higher than that right now. So it's continuing to rally. But that historically has tended to be the normal. The stocks turn bullish after post evasions. So we're not too worried about that because the probabilities are on our side that there will be a rally. And of course, we're experiencing that now. We didn't pull any money off the table during all the crisis. We stayed invested, and that was a good decision. Here's just a little different graph on this current one. You can see as things started to build up, it was de-risking, all the way down. And then you can see once the invasion actually happened, the market took off. And so after post invasion, just like most of the other charts historically, this one went to new highs in the current trend. If you go back to April, all the way back to our last high of over 6,100, in which we're very close right now. We may even break it. I'll have to look, but we're getting close to breaking our new high. But you can see it was a good decision to buy the invasion. And that historically has proven out. Here's another positive, tariff revenue. You can see the tariff revenue from last year to this year. And you can see that the amount of money coming into the U.S. Treasury is rising. And it's amazing, but we're probably close to $18 billion of revenue every month. So this is a lot of money coming in the Treasury to offset our budget deficit and other things. And this is what Trump wanted, is to bring in plenty of revenue to the Treasury through tariffs. And the big question again is whether those tariffs will eventually come down into the economy and begin into businesses and start to raise inflation, which I think we'll see over the next month or two. I don't know if it's a short-term phenomena, but I would expect inflation to bump up eventually. Right now, the hard data does not say that, but the soft data is pointing to that. Consumer still spending, and you can see that we're still up pretty high in the core retail sales year over year. You can see the year over year, which is the blue line, and then of course the month to month is down below. But you can see, it has volatility. There'll be a month where it goes negative, but you can see we're still up pretty high. This is still saying that the consumers are still out there spending and buying things. So we haven't seen a big slowdown in this. And of course, the Fed is watching this very carefully to help them make their decision on interest rates. But this looks pretty stable, not too bad for what all the things going on in the world. Okay, here's the forecast for GDP growth. You can see the long-term average was 2.1%, and you can see we are above that over the last several quarters. But now what we're expecting over the years, you can see that we're expecting it to be still positive, but this is what we're saying when we see the economy cooling off. The Fed sees the economy cooling off. You can see the yellow bars there. They're lower than the last 3 years, but it still is not in recession territory. So the Fed does not see a recession. Paul keeps saying the economy is cooling, but it's still solid. So this is good. This is good for the stock portfolios. We expect them to continue to rise even with lower GDP growth, but there's nothing out there saying we're going negative. This is the Fed funds relative to the 10-year yield. And you can see that the blue is the Fed funds rate, and the 10-year yield is the yellow line. And if you look, you can see when the Fed really went hard on dropping interest rates, and the yields followed that. But you can see what looks like the economy was in a soft landing back in the 90s. And if you go to the left side of the chart, you can see the Fed dropped some rates a few times like they have already. They actually raised it, but they didn't really drop it until the economy had significant problems. So we could be right now, the interest rate level of the 10-year and where the Fed is pointing that this economy is not going to fall apart anytime soon. It looks more like they're cooling down in what we call soft landing, where hard landing would be a recession, but right now this points to they're forecasting a soft landing. And then of course, inflation, this is the big one. But you can see where we peaked in 22 and where we are now. You can see it's both the CPI year over year and the core CPI. And you can see that they're both under 3%, and the target is 2%. Well, we're not that far from 2%, and it's going directionally in the right place. So what this tells us, the hard data is pointing to there is no inflation right now. Now, again, we're going to have to see how tariffs come in over the next 2 months, how that impacts inflation over the next 3 months. Will tariffs actually raise the inflation rate? But so far, the data has been coming in below expectation. So in other words, inflation, the hard data is saying it's okay right now. And what happens when you have, right now we're in that 2 to 4% place for inflation. And of course, the target is 2% for the Fed. We're just a little higher than that. But you can see this is the average PE ratio, or price to earnings ratio, compared to the CPI. And you can see it was the second highest PE ratio. In other words, when inflation is in that 2 to 4%, you can have higher PE ratios, which we do today. And of course, if inflation went back to the 4 to 6 or even 6 to 8, you can see the price earnings ratios begin to go down. So we're looking pretty good, and we'll see where this all ends up. I think if we stay in that 2 to 4 range, we'll be in fine shape. And I think if we do get some tariff inflation, I think it's going to be very short term. Right now, the bond market does not see higher inflation. So right now, the bond market and the forward look, it's actually below where it started at the beginning of the year. So right now, the bond market says there is no inflation from tariffs. You can see the Liberation Day, it shot up to 3.4%, but now it's at 2.38, the 1 year expectation. So there doesn't, at this point, the hard data and the bond market is saying there's not going to be high inflation. And Conference Board, this is the 1 year median. This is consumers, what they see. But look at the drop. It drops significantly in this last two data points. You can see where that arrow is going down, where we had this is sort of a sentiment from consumers, what they think, but you can see they're starting to agree with the bond market that inflation's coming down. These are expectations, and of course they're in the same direction as the hard data. Now, shelter, this is a big component in the CPI. You can see that's been coming down. It's down at 3.86 from its peak, and this is a big weight in the CPI. And it's actually heading towards the 20-year average of 3.11%. You can see the trend in the monthly in the bottom part of the chart is heading down. So we have this is important because of its weight in the CPI. But this could have, if this continues, which we think it will, it's going to have great impact on lowering inflation. And so with all this inflation, hard data, the Fed still is holding to 2 cuts, but so is the forecast, you can see, for 2.2 cuts. So we went from 2 to 2.2. So there's been a little increase. It's not going down. So I'm expecting 2 cuts as we move forward through 25. And of course, if employment starts to weaken, you'll see even more cuts. So this is a big one. This is what the Fed's watching. This is the labor market. Jobs are becoming harder to get. This actually shows plentiful minus hard to get jobs. And you survey and you can see it's been falling, which means it's getting harder and harder to get change. And you're seeing people stay where they are. Earlier, 12 months ago, many people were just jumping ship and going to other companies because they could get a pay raise. That is not happening anymore. So many people are staying put. So because there's less jobs available. So this is a sort of a weakening in the employment numbers. We'll see where this goes. You can see in the next chart, that it's cooling, but it's not cracking yet. There are some I would say there are some cracks, but it's very low. You can see the 2024 average, where that red line is compared to the 25 this year average, and you can see that the numbers are starting to come down. This is a change in non-farm payrolls, 3-month average. So what this is saying is it's lower. The job market is starting to weaken or cool, but it hasn't fallen off a cliff. And here's another way to look at it. You can see that job growth has cooled, but unemployment remains under 4.5%, which is sort of a key number. And you can see actually it's been creeping up, but you can see the overall unemployment rate is still kind of holding steady and below that 4.5%. So this is all good news. So this is the hard data. Now, of course, where employment goes, where the labor market goes is going to be key to whether the Fed does 2 or more rate cuts this year. And of course, if the employment started falling apart, that would have an impact on the stock market. So this is on our watch list. Here's our updated outlook, but first I want to look at last month's outlook. And you can see I checked 4 checks. These are some of our forecasts that have been in our forecast list for the year. And U.S. economy weaker, recession odds currently falling, and that has continued. As we've talked about, there's no signs of a recession. You don't hear too many people talking about it. That has come to pass. We said there would be lots of stock market volatility, would remain high, but look at big moves to the upside. That's what we're experiencing. We forecasted that we thought that there would be big moves, especially with the cash levels, the shorting that's going on. So right now, those 2 have come to pass. And we talked about a technology stock restart. Remember, we went into a lot of technology stocks in March, and that has been very fruitful. So the leadership shift back to tech has happened and is happening right now. So that one has come to pass. Of course, we have some others that have not yet come to pass. And then we had one of our wild cards began to turn, the geopolitical wild cards. And what happened was Israel and Iran did take place, but it wasn't negative on the stock market. It was actually turned out positive. So this is our new updated. We do expect the economy to cool, but we do not see a recession. Volatility remain high, and even expect more big moves to the upside. If we break new highs, I think some of that cash from institutions and retail may come flooding into the stock market. And then, of course, you have technology stock leadership continues, especially in AI. Inflation will eventually rise temporarily by tariffs. We expect that over the next several months, but then retreats. Unemployment rises, maybe heading to 5%. I think that's still a possibility that could take place, which would cause the Fed to start cutting rates to offset that unemployment if it begins to crack and become weaker. And when that happens, when rates go down, bonds rally. So we expect a bond rally sometime this year as the Fed lowers rates. So, but we've raised our stock year end. It's positive. So stocks recover by year end, achieving a 5 to 10%, 15% return. We're at 1 to 10 last month. We've raised this, so we're expecting that to continue. That we've raised, like other analysts out there, they're raising their stock S&P target for the year end. So are we. We raised it about 5% from where we were, the range. And of course, we have all our wild cards, geopolitical events. You have assassination. A lot of people want to kill our president. We've got Ukraine, Russia. Where does that go? Does Israel and Iran restart? What about the proxies? Do they restart? What about China and Taiwan? That's still yet to come. So those are wild cards. Again, we cannot forecast or predict. We can list them, but it's impossible to forecast geopolitical events. And so what we are showing is some risk out there. We already had one of them with the Israel-Iran, but it turned out very temporary hit on the market. And of course, we're recently at new highs. So it hasn't really impacted the overall U.S. stock market. And there's still some catch up in the U.S. stock market relative to international developed countries. The performance gap this year is pretty large. U.S. has always, not always, but more frequently outperformed international stocks. But I think we're starting to see a move back to United States stocks.
Excellent. Thank you, Tom. Very much appreciate you, your balanced approach, positives, headwinds, what you think it all means, and just having the cool head to present all this material to us. Thank you for putting it together and sharing it with us today. So just fantastic.
Thank you.
For everybody who's on the call here live, I do see a number of you out there. If you have any questions, now would be a great time to post that in the comments, to email me directly. If you have my text number, you can also text me. I'm watching all three of those spots. Would love to field any questions that you may have. While those may come in, Tom, I'll just point out a few of the charts you're talking about on reasons to be bullish, and when we hit new all-time highs. All-time high was February 19th, I believe. It was like on the S&P was, I think it closed around 6144. So we are about 14 points away from that all-time high. So we are just hair thin.
We are hair thin, and if it breaks through that all-time high, I believe there's going to be a short squeeze, and much of that cash, which is sitting earning low interest rates, 4%, are going to come out and start moving towards stocks, unless there's something outside of what we're all seeing right now. But I think the fear right now is the tariff impact. We haven't seen it yet. The Fed thinks that it will impact inflation at some level. They don't know, but so I don't think anybody knows. But we'll have to see what the inflation numbers are going forward. But if we break a new high, then all these investors that are short or in cash are going to have to make a decision. Do I want to miss out? It's called the fear of missing out, FOMO.
Exactly.
And if that happens, it could be a face ripper to the upside.
Awesome. Yeah, I do have one question that came in here on the immigration and inflation front. Jeff in Minnesota, thank you very much. He says there are reports that up to 1 million people have voluntarily left the country through the federal program. If accurate, could this be contributing to the recent cooling of inflation, particularly in housing and rent costs? And if so, what other potential effects might this have on inflation going forward?
That's a good question. Very good question. 1 million people, I don't know if that will have a major impact. It will have some impact, but I don't think it will be large. I think I don't think the direct connection to inflation to the immigration 1 million people will be very big at all. So that's my view of that, is that it will help in other things, but I'm not sure it's going to have a big impact on inflation. It'll probably help it a little bit, but I don't think it will be large at all.
Thank you. And thank you for the question, Jeff. We appreciate that. Let's check here. All right, as any more questions might be coming in, I'll just remind any of you who are watching in the recording, we would love to field your questions. So please do not hesitate to post your questions, email me, text me, reach out, however you want to do that. I would love to circle back with you. Later on today, I will have a summary of today's message on the website. We can go and click that download summary button right there. It's not up yet, of course. I'll get that done here in the next couple of hours and onto the website, and then an ability to ask a question right there as well. If you'd like to keep it confidential, no problem on that front. For those of you who are new here today, Quick reminder, every Monday morning, I start my week off with a much shorter kind of update of what's happening in the markets, in the economy. 3-5 minutes, sometimes 7 minutes tops. Again, summarizing what's going on and some things that we're watching for. Broadcast out on all the different social media channels. And then later on that day at 2 p.m., I send out an email linking back to that if you're not able to join me live in the morning. So if you're not getting that email and you would like it, you can subscribe at our website, which of course is investwithccg.com. And for all of you clients on the call or watching the recording today, if you have not received the notice in the mail, you should have. If you didn't, please save the date. We are very much so looking forward to our Capital Cruise dinner appreciation event. It is scheduled for the evening of Thursday, August 21st. We value you. We love to celebrate you, and we're looking forward to this annual event on Lake Minnetonka. We have once again reserved the best boat on the best lake for the best clients. So very much looking forward to that. And yes, an invitation will follow. So you should have received a save the date postcard at this point. So with that, I'll check one more time on any questions. I don't see any more questions, Tom. Any closing thoughts? Otherwise, I can wrap us up here.
No, I think we have the balanced approach. We have the impact of tariffs probably unfolding in the next month or 2 or 3 months, and we'll see where that goes. And then you have, of course, the tariff agreements, and those are something we're looking at. And then, of course, employment. What happens to employment? And so if employment is cooled, but if it holds steady, that will be positive for stocks. And right now, everything seems to be shifting. The sentiment is to bullishness in the stock market. And the big question is, will that cash and will those shorts start to cover as they keep losing money or leaving money on the table? And if that happens, I think we could see more big upside. Daily upside, lots of volatility because it could go either way, but you kind of have two sides. You've got the bullishness, earnings, revenues on the one side. Consumers are still positive. Inflation's hard data is coming down. Then you have all this on the other side, the geopolitical, plus you have the inflation impact. Well, how much will the tariffs actually impact inflation? And that right now, the data has been just the opposite of what most expected. But as the Fed said, they think it's going to unfold over the next 2 to 3 months. So we're going to keep our eyes on that as we move forward.
Very good. Well, again, thank you. We appreciate you. Thank you to all of you who joined us here live today. And for those of you watching the recording, that does conclude this month's capital markets update and outlook for the month of June 2025. We'll look for you again next month. Bye, everybody.
Bye, Eric.